Welcome. Today we're diving into the world of business financing, focusing on two major options, debt financing and equity financing. Whether you're starting a new venture or looking to expand, understanding these two methods is crucial for making smart financial decisions. Throughout this video, we'll break down what each option means, their pros and cons, and how they impact your business in the long run. Let's start by exploring the basics and setting the stage for a deeper comparison. Ready to discover which financing method could be the best fit for your business goals? Let's get started. Financing is when a business borrows money that must be paid back over time, usually with interest. This can come from banks, private lenders, or issuing bonds. The key point is that you retain full ownership of your business, but you're obligated to repay the borrowed amount according to agreed terms. Debt financing is common for businesses that want to maintain control and have predictable repayment schedules. However, it does mean taking on financial risk, especially if cash flow becomes tight. Let's look at how this works in practice and what it means for your company. Equity financing involves raising money by selling shares of your company to investors. Instead of repaying a loan, you give up a portion of ownership in exchange for capital. This can come from venture capitalists, angel investors, or even public stock offerings. Equity financing is attractive for startups and businesses with high growth potential, as it doesn't require immediate repayment. However, it means sharing future profits and decision-making power with your investor. Let's explore how equity financing works and why some businesses prefer this route. One of the biggest differences between debt and equity financing is ownership. With debt financing, you keep full control of your business, since lenders don't get a stake in your company. On the other hand, equity financing means sharing ownership with investors, who may also want a say in major decisions. This can be a significant factor for entrepreneurs who value independence. Understanding how each option affects your control over the business is essential before making a choice. Financing comes with a clear repayment schedule. You'll need to make regular payments, including interest, regardless of how well your business is doing. This can put pressure on your cash flow, especially during slow periods. Equity financing, however, doesn't require fixed repayments. Instead, investors expect a return through dividends or by selling their shares if the company grows. Each method has its own risks and rewards when it comes to paying back the money you've raised. Cost of capital is an important consideration. Debt financing usually involves paying interest, which can add up over time. However, interest payments are often tax-deductible, reducing the overall cost. Equity financing doesn't require interest payments, but you're giving up a share of future profits, which could be more expensive in the long run if your business becomes highly successful. Weighing these costs is key to choosing the right financing method. Every financing method comes with risks. With debt, the risk is mainly financial. If you can't make payments, you could face penalties or even bankruptcy. Equity financing spreads the risk since you're not obligated to repay investors if things go south. However, you might lose some control over business decisions. Understanding these risks helps you prepare for challenges and choose the option that matches your risk tolerance. Financing can strain your cash flow due to regular repayments, especially if your business experiences seasonal fluctuations or unexpected expenses. Equity financing, on the other hand, provides capital without immediate repayment pressure, allowing you to reinvest in growth. However, sharing profits with investors can reduce your take-home earnings in the future. Balancing cash flow needs is a critical part of your financing decision. Equity investors often bring more than just money. They may offer expertise, connections, and strategic advice. However, they also expect a say in how the business is run and a return on their investment. Debt lenders, in contrast, are mainly concerned with getting their money back with interest and typically don't get involved in business operations. Knowing what each party expects can help you manage relationships and set clear boundaries. Time it takes to secure funding can vary. Debt financing, especially from banks, may involve lengthy approval processes and strict requirements. Equity financing can also take time, particularly if you're pitching to multiple investors or negotiating terms. However, some equity deals like crowdfunding can be quicker. Understanding the timeline for each option helps you plan your business activities more effectively. Financing usually requires a strong credit history and collateral, especially for larger loans. Lenders want assurance that you can repay the debt. Equity investors, on the other hand, are more interested in your business's potential for growth and profitability. They may be willing to take a chance on newer companies with less established credit. Knowing what's required for each option can help you prepare your application and improve your chances of success. When you take on debt financing, lenders often require collateral, assets they can claim if you default on the loan. This could be property, equipment, or inventory. Equity financing doesn't require collateral since investors are buying into your business's future success. This difference can be crucial, especially for startups that may not have significant assets to pledge. Interest payments on debt are often tax-deductible, which can lower your overall tax bill. Equity financing doesn't offer this benefit, but dividends paid to investors are not tax-deductible. Understanding the tax implications of each option can help you maximize your after-tax profits and make a more informed decision. Long-term effects of your financing choice can shape your business's future. Debt financing can be paid off, allowing you to regain full financial freedom. Equity financing, however, means sharing profits and decision-making for as long as investors hold their shares. Consider how each option aligns with your long-term vision and exit strategy. Debt agreements often come with covenants, rules about how you can operate your business. These might limit additional borrowing or require you to maintain certain financial ratios. Equity investors may also set conditions, but these are usually focused on major decisions. Understanding the flexibility and restrictions of each option helps you avoid surprises down the road. Startups often face unique challenges when raising capital. Debt financing can be tough to secure without a proven track record or assets. Equity financing is more common for early-stage companies, as investors are willing to take on higher risk for the chance of big returns. Choosing the right option depends on your business stage and growth prospects. Equity financing can provide the resources needed for rapid growth, especially if investors bring industry expertise and networks. Debt financing may limit growth if repayments consume too much cash flow. Consider how each option supports your expansion plans and whether you need more than just money to succeed. Your choice of financing can affect your exit strategy. Debt can be paid off before selling the business, making it more attractive to buyers. Equity investors may expect a return through an IPO or acquisition, which could influence your timing and terms. Think about how each option fits with your long-term plans for exiting the business. Maintaining control is a top priority for many entrepreneurs. Debt financing allows you to make decisions independently as long as you meet repayment terms. Equity financing often involves giving investors a voice in major decisions, which can be helpful or challenging depending on your goals. Decide how much control you're willing to share before choosing a financing path. Debt financing appears as a liability on your balance sheet, while equity financing increases your company's net worth. Lenders and investors look at these numbers when assessing your business's health. Understanding how each option affects your financial statements can help you present your company in the best light to future partners. Interest rates on debt can vary widely based on your creditworthiness and market conditions. Fixed or variable rates, loan terms, and repayment schedules all affect the total cost. Equity financing terms are negotiated with investors and may include preferences or special rights. Comparing these details helps you avoid costly surprises. Equity financing dilutes your ownership, meaning your share of profits and control decreases as you bring in more investors. This can be a trade-off for accessing larger amounts of capital. Debt financing doesn't dilute ownership but increases your financial obligations. Understanding dilution helps you weigh the true cost of equity funding. Managing relationships with investors is a key part of equity financing. Regular updates, transparency, and clear communication are essential for building trust and aligning goals. Debt lenders require less ongoing interaction, focusing mainly on repayment. Consider your comfort level with investor relations when choosing your financing path. The state of the economy and financial markets can influence your financing options. Low interest rates make debt more attractive, while a strong stock market can boost equity valuations. Timing your financing to market conditions can help you secure better terms and maximize your resources. Both debt and equity financing are subject to legal and regulatory requirements. Debt agreements must comply with lending laws, while equity deals often require securities filings and disclosures. Working with legal professionals ensures you meet all obligations and avoid costly mistakes. Common forms of debt financing include bank loans, lines of credit, and issuing corporate bonds. Each option has its own terms, interest rates, and repayment schedules. Businesses often use debt to finance equipment, inventory, or expansion projects. Choosing the right type of debt depends on your needs and ability to repay. Equity financing can come from venture capitalists, angel investors, or public stock offerings. Startups often seek equity funding to fuel rapid growth, while established companies may issue new shares to raise capital. Each source has different expectations and involvement levels, so it's important to find the right fit for your business. Some businesses use a mix of debt and equity financing, known as hybrid financing. Convertible notes, mezzanine financing, and preferred shares combine features of both methods. Hybrid options can offer flexibility and balance, but also add complexity. Understanding these alternatives can help you tailor your financing strategy. There's no one-size-fits-all answer when it comes to financing. Many businesses use a combination of debt and equity to meet their needs. The right mix depends on your goals, risk tolerance, and market conditions. Regularly reviewing your financing structure ensures you stay aligned with your business strategy. Let's look at a startup that used equity financing to launch its product, attracting investors who provided both capital and guidance. As the business grew, it later took on debt to finance equipment purchases, balancing ownership and financial obligations. This approach allowed the company to scale quickly while managing risk. An established business with steady cash flow might choose debt financing to expand operations without diluting ownership. By securing a bank loan, the company maintains control and benefits from tax-deductible interest. This strategy works well for businesses with predictable revenue and strong credit. A company experiencing rapid growth may turn to equity financing to access large amounts of capital quickly. By bringing in investors, the business can scale operations, enter new markets, and innovate faster. The trade-off is sharing profits and decision-making, but the potential for accelerated growth can outweigh these costs. When a business faces financial difficulties, debt financing can become a burden due to fixed repayments. In such cases, equity financing may offer a lifeline as investors share the risk and don't require immediate returns. However, this means giving up more control at a challenging time. Each situation requires careful consideration. Financing trends vary around the world. In some countries, debt financing is more common due to strong banking systems, while others favor equity investment, especially in tech hubs. Understanding global perspectives can help you identify new opportunities and adapt your strategy to different markets. Recent trends show a rise in alternative financing options such as crowdfunding and peer-to-peer lending. These methods combine elements of debt and equity, offering new ways for businesses to raise capital. Staying informed about trends helps you access innovative funding sources and stay competitive. Choosing the wrong financing option can lead to cash flow problems, loss of control, or missed growth opportunities. Common mistakes include underestimating repayment obligations, overlooking dilution, or failing to plan for taxes. Learning from others' experiences can help you avoid costly errors. Financial advisors recommend carefully assessing your business's needs, growth potential, and risk tolerance before choosing a financing method. Consulting with professionals can help you understand the fine print, negotiate better terms, and align your financing with your long-term goals. Before seeking financing, prepare a solid business plan, financial projections, and clear documentation. Lenders and investors want to see that you understand your market, have a path to profitability, and can manage risks. Preparation increases your chances of securing the best terms. Negotiating the terms of your financing is just as important as choosing the right option. Pay attention to interest rates, repayment schedules, covenants, and investor rights. Don't be afraid to ask questions and seek clarification to ensure you fully understand your obligations. After securing financing, regularly monitor your business's performance against projections. Track cash flow, profitability, and compliance with loan covenants or investor agreements. Staying proactive helps you address issues early and maintain strong relationships with lenders or investors. Business conditions can change quickly, affecting your ability to meet financing obligations or take advantage of new opportunities. Stay flexible and be ready to adjust your financing strategy as needed. Regularly reviewing your options ensures you remain on track toward your goals. Strong creditworthiness opens doors to better financing options and terms. Pay bills on time, manage debt responsibly, and maintain accurate financial records. Building a solid credit history takes time, but it pays off when you need to access capital for growth. Strong relationships with lenders, investors, and advisors can provide valuable support and resources. Networking, clear communication, and trust building are essential for long-term success. Leverage your relationships to access new opportunities and navigate challenges. Regularly review your financing structure to ensure it still meets your needs. As your business grows and changes, your capital requirements and risk profile may shift. Adjusting your approach keeps you agile and prepared for whatever comes next. Summary: both debt and equity financing offer unique advantages and challenges. Debt allows you to retain control but comes with repayment obligations. Equity provides capital and expertise but requires sharing ownership. The best choice depends on your business goals, risk tolerance, and growth plans. By understanding the differences and carefully weighing your options, you can make informed decisions that set your business up for long-term success.